Hi, everyone, and welcome to another episode of the Veritas Fact Finding Series. And today I'm joined by my guest, David Thomas. David, nice to have you.
Nice to be here.
We're back on the ground to speak with industry professionals in an unscripted, candid video format to discover how we can make better investment decisions. If you're watching and you like what you hear, give us a like and follow us at www.veritascorp.com. I must note a very quick disclaimer. This broadcast is not to be taken as investment advice, and participants and/or employees of the Veritas Group of companies may own securities discussed in this broadcast. And while we love all our guests, and David in particular, this session may contain forward-looking statements, investment opinions, and comments that we may not agree with. Now, I want to give some framework and context to today's discussion because I'm quite excited about it. It's going to be a little different. We'll spend a lot of time talking about markets, macroeconomics, investing strategies on sessions that we've had here. But behind every great long-term compounder is usually something deeper, a philosophy, a culture, a way of thinking about risk, and perhaps most importantly, a way of surviving. Few Canadian companies have inspired more fascination among serious investors than Fairfax Financial, and of course its founder, Prem Watsa. For decades, Prem's been called the Warren Buffett of Canada, a legendary investor, a crisis strategist, and one of the great capital allocators of his generation. But despite building Fairfax from a tiny insurance acquisition into a global insurance and investment powerhouse, Prem himself has remained remarkably elusive. He rarely gives interviews, he's avoided the spotlight, and unlike many CEOs, he doesn't show up on the front cover of magazines. And that's what makes today's conversation and the work that my guest David Thomas has done so unique. He's a veteran journalist, former editor and media executive, and now author of the book, The Fairfax Way, the first major inside look at Prem Watsa, Fairfax Financial, and the philosophy behind one of Canada's most fascinating corporate stories. Whether you own the stock, whether you don't own the stock, whether you're building a company or you're thinking about making investments, this is going to be a story that you need to hear about because it brings about conviction. It talks about how mistakes have been made, how you survive to run a business, hedge fund attacks, and ultimately how you reinvent yourself to build and sustain a business. Today, we'll discuss why it is that Prem finally decided to open up, the rise, fall, stall, and rise again of Fairfax, the psychology of crisis investing, and we're going to, of course, dig into what David has pulled out from Prem to look at what's currently going on, the geopolitical uncertainty, inflation, AI, etc. So with that, David, I always like to start out with our guests to tell us, to have them tell us about themselves. Why is it that, you came from your early beginnings? How'd you get into the media and become an editor and then transition to where you are today?
Thank you for that introduction. My story, I started out in Vancouver, which is where I grew up, and decided to get into journalism. Wasn't absolutely certain it should be business journalism, but it seemed like a good place with better prospects, maybe long term. I may have got out just the right time because
Brilliant.
It's a little bit grim out there now. But anyway, business turned out to be, for me, just really intellectually rewarding because it was harder to do the stories. You could use your own brain and look at numbers. You could dig into things and find stories and allow numbers to help you tell stories, which weren't always in the news releases. And, you'd have to do a little more digging. So it was rewarding that way. So I worked at the FP. I was backup bureau chief for Reuters for a little while. And then I took a permanent job and moved my young family, had two young boys, to Toronto with the old Financial Post. So that's when it's a tabloid.
That's when we first met.
Yeah. So what is that? End of 96, beginning of 97.
Yep.
So, and I wrote on markets. That's what I really love to do, was the investing stuff, especially. They were, trying to get me to do other things. And I actually really liked that stuff. did mining, had worked on the Briac story and things like that, which were fun. It was probably my, you know, biggest regret is having really kind of figured it out through getting a very good source who helped me see it. Now proving it was a different matter, and I think I kind of fumbled in not pushing it harder or finding other ways to advance what I had then. But that was a good learning experience. Really interesting story. Um, and then from there went into economics. So I was the economics and markets correspondent, which the best job for someone like me, and really high profile, great job to do. Things were just sort of getting going, and then Conrad Black decides to buy the paper. And
Yeah.
they'd already been working up the launch of the National Post, and they decided, uh, I don't know, I think the story goes, was it just the name of it, or was the strategy ascribed to his barber? I don't know if that's a true story or not, but yeah, you should buy the Post and roll it up. And so that's how they came up with the National Post. They took the FP, the
Yeah.
Financial Post's name. So we had two business sections in a four-section newspaper. It was a great time, and that was, the early 2000s.
How about
There it
that?
is. There it is. And yeah, no, so that was probably the best job, I think, in business journalism, because I moved up from investing editor to managing editor. And 2004, it seemed to start peaking, and we had to start letting a lot of people go, and I went down to the Globe and Mail. And so from there I ran ROB newsroom, took a break from journalism, and helped rework an investor education focus for IROC. So did my stint in regulation, which was a little stodgy, and I ran back a couple of years later to media, working on titles at Rogers, Money Sense and Marketing, and Canadian Business, Maclean's. And yeah, so I had a great career, loved it, and had followed the Fairfax story reasonably closely, never quite able to figure out exactly their financial statements. That they just seemed very not hiding anything, but just there's a lot of stuff in there, and for reporters who don't want to spend the time, it was always hard to figure out, and that's one of the big things I wanted to accomplish when we ended up doing the book, was really just for the people who've never heard of them, let's explain this. It's a great story, many different angles, but also for the people who think they know it, but don't really understand it, to try to get in and help people understand how they make their money and how to value them, and lift the veil on a lot of interesting history. So there's my spiel.
Nice. In the preface, Prem says, "Who could have seen that coming? I sure didn't." And it's really that phrase really stuck out at me, because
Yeah,
it's striking, because markets portray Prem almost as someone with supernatural foresight. So what
yeah.
changed? Why now does he all of a sudden want to talk to this journalist editor named David Thomas?
Right. Well, there's a couple of things in there. One is what was he seeing then, which is interesting. I think, and that to me is really interesting, because here's a guy who should, he knows this company better than anybody. He knew the fundamentals were improving. He knew, but the thing is, stuff always happens, right? And when you're a long-term thinker, you concentrate on doing things right, or the way you think you're going to do them right, and you hope that you're in a better shape in 2, 5, and 10 years. I think for him, it was like, there was always an offset. If the insurance part was doing great, the investments might be hurting. In the early days, the insurance did terrible, and the investing offset it. So they were never in a position. So I think what he was speaking to there, they were never in a position where they had both of those main engines going, and this third engine that they've been working on, earnings engine, of operating companies that weren't insurers. So C-SPAN investing, Eurobank, you've got all kinds of airports in India, they've got all kinds of assets that had kind of grown up into this third leg of earnings, and all of a sudden everything was clicking. And big turn in interest rates, and they could actually make money from the bond market, which had been, terrible for well over a decade, in deflationary period. So anyway, that's what he was looking at. The answer to the question, why now? I think I kind of got just lucky. I did a piece with him, and he didn't like to talk about the company. He didn't want to get into issuing projections and forecasts and that kind of thing, or they're not going to reveal any investing secrets. And so he never saw a lot of use for media. But in this case, I threw a question at him just to look at the state of capitalism globally and in Canada, and what's going on with the economy. And I was super surprised when he fired back saying, yes, come on down. And we had a long chat, and I did a piece, ran in the FP and in the National Post. And, and then we just kept talking. I think he really enjoyed the conversation, that I could kind of translate him, because it was kind of a rambling conversation. But
how many years ago was that? This is more recent, or this is many years
yeah.
ago,
So
right?
that is is that the end of 21? I think that's the end of 21, right in December.
So you went back to go work at the Financial Post after
I
the
did a
goal?
stint trying to help them chart a new direction.
Right.
And then we decided that wasn't really working. So
Fair. We're going to
the
get to media a little later, because we do want your insights into what's going on in the space today. But anyway, keep on.
Yeah. Anyway, so that's the why now story is, we had this conversation. My guess is, I mean, I've never asked him directly, but is that I think he felt like I could translate him, that there was a good conversation that really kind of put forward important things that he was trying to say about capitalism and free enterprise. And he's been doing a lot of work setting up new institutes and things of late, and really trying to make sure that Canada can stay competitive. So those are things that were important to him. And yeah, I was totally surprised that he took the call and did it. And then what happened was the conversation didn't stop. So then it was, let's talk more. And then it's like, well, maybe we need to tell our story a little better. But it was a long process.
How long did it take you to write the book?
Well, I'd say start to finish, we're looking at 3 years.
Wow.
Because a lot of it was just, a bit of a dance and getting to know each other, and me getting reacquainted with the story, and them trying to figure out if they wanted to do a book, if they wanted to do a private book, if they wanted.
It's great. It doesn't feel like it's not promotional. It's like you being a forensic reporter, actually challenging some of the things that happened, right? Asking the question why.
Yeah.
That's why I think it's such a good book, actually.
Well, thank you, Anthony. It was a challenge. It's I was the first person they ever let in. They've done a few interviews. I know Amanda Lang has interviewed him way back, and the Globe and Mail got one cover. You saying he's not on the cover of magazines? He was on the cover, and it was in 2006, and it was right at the peak of this war with the hedge funds in New York, and they were in trouble. I mean, it was a really messy thing. I guess we'll get into that more later, but
he wasn't on the cover because what a great person. It was more the part of the scandal, and they were trying to point out, okay, who's right, who's wrong. I remember that time. We're going to talk about it. Okay.
Yeah. So anyway, that's so yeah, the conversations just turned into more, and then or can we do a book? And it didn't happen as fast as it normally would. Hey?
Was there a lot of editing? You wrote something and then it went back to the powers that be at Fairfax. They pushed back and said, nope, we're not putting that sentence, and nope, change the framing here.
I spent time with it, and then came up with an outline, and I don't think they ever offered any changes as far as that goes.
Great.
And then
okay.
the deal was they got a look at it at the end, and they had to be comfortable with it. But nobody was
there wasn't significant
what
editing.
to write or how to structure it or anything. So I had the full freedom of that.
That's great to know. Okay,
Yeah.
so let's dig into the person to the extent that what you learned. Let's talk about the making of Prem Watsa. Who was he before he became, as we know, Prem Watsa of Fairfax? What stood out most to you about his upbringing in Hyderabad,
Yeah.
the early '70s with very little immigration, all that? Let's talk through that.
Yeah, it is a very interesting story, and that's why I hope, the piece I always wrote, even if I'm writing something really complicated, I want somebody to be able to walk into the story and not knowing anything about it and be able to learn. And this story stands up not just for the people who are really interested in insurance or
Exactly.
his investment portfolio. He's got a really neat story. The family, backing all the way up to the mid 19th century, was converted to Christianity. So they've always kind of been a contrarian in different ways. The family never, wasn't poor, but he didn't come from money. And but the over the generations, there was this tradition of teachers on his father's side, and it carried on to his father, who was an orphan and worked his way up through the different schools in India, did some training in the UK, and he taught at great schools. And Prem benefited immensely because he was able to attend. So, I mean, his story is all about fate and these opportunities that come along, and changed his story as it went along. So he got in there, and through that was able to write to the super elite college. He did an engineering degree. Then he decided he didn't like engineering, so he was going to go back in and do a business degree. And he met his wife while he was earlier in school, or future wife. And so he was ready to get married. He was ready to take his business degree and see what happens in India. And his dad just really felt that India was uh, too much into too socialist, too much tied into 5-year planning, not dynamic enough. And so he said, "Prem, you're going to Canada." And at the age of 22, he went to London, Ontario, and did an MBA at Ivy.
Right.
And his brother had moved there before, because he had married a woman whose family was in London. So he got a broom closet sized room in his brother's house, actually, that they were renting from somebody else. And um, not a lot of money. Didn't know what he was going to do. Didn't come from an investing background at all. Didn't understand stock, what a stock even was. Um, and there were a bunch of moments in his career where he just, the light bulb bright goes on, and he had one instructor that taught them about stocks, and he just fell in love with the idea of investing and figuring out how to analyze a stock and how to figure out if it's a good investment. So yeah, so that was, and then leaving that program, fate again. I think he got a couple of job offers. One was with 3M, just as an analyst. He would have stayed in London, and I think we probably would have seen a very different story. Who knows where that path would have gone? But
Yep.
he took a junior analyst job at Confederation Life, which was not the high cachet, high paying jobs on Bay Street. It wasn't Wood Gundy. And but he, big fate, moment of fate. Number two here, his supervisor, John Watson, was a Benjamin Graham nut. And so even though he had gone through this whole program of an MBA and done investment training, he wasn't really clear on the value approach. And this is his mentor turned him on to it, and that just made him completely convinced that this was the way that he wanted to have his career, and that value was going to unlock his future. So
So, what do you think when he first came to Bay Street on that job there in Confederation Life. What was it that you think differentiated him early? Intellect, discipline, was it something else, you think?
Well, I mean, he
Because you
was,
mentioned fate a couple of times, and I
yeah,
think
yeah,
that's
yeah.
important.
Well, that's the people you meet usually
But it's
is
the
what
people
I'm
you
thinking.
surround yourself with. You see, you're
Yeah,
not going to meet the right people surrounding yourself with the wrong people.
yeah, yeah,
Magic happens when you surround yourself with people you like, trust, and admire. How do you like that?
yeah. A lot of the people that he worked with there or worked with immediately after um, are either still at the firm, and we're talking 50 years later.
I believe it.
Um,
No, he's
eh,
a very loyal
you
guy.
know, yeah. So his network was had a lot of stickiness to it. Um, but yeah. So the people were there. He was looking at different options because eventually he decided that the Confederation Life thing wasn't, you know, he had to grow beyond that. So they were going to set up something. They in the end they did with the Tony with Hamblin Watsa was the name of the firm. So
Yep.
they said, "Hey, we're going to put our own shingle out there." They secured a bunch of investment accounts, and sort of thinking, this is a great story if you just stop it right there, right? This is immigrant makes good. He starts raising a family. He's got a business, and then big moment of fate later. Uh, um, was meeting Francis Chu, who's a really interesting value investor that's been
Yep.
around for a long time, and he turned Prem onto the Buffett model. Prem didn't really appreciate. He knew Buffett was a good investor. He didn't really realize the magic of float until Francis mentioned it to him. So here they are. It was like 1984.
Yep.
He'd been in Canada for 12 years. They launched this firm, and then he has this conversation with Francis Chu, and says, "You know how Warren Buffett makes his money?" And Prem said, "Yeah, he's a great investor. He buys Gillette, American Express, Coca-Cola." And he said, "No, yeah, but it's the float. It's the insurance magic that gives you, if you're a smart investor, you can either have free leverage or even be paid to take that money as leverage to invest when you take the premiums that have been written but not paid out yet." So, and that's still a huge advantage for Fairfax. So anyway, with the big tip on Buffett, it was really just a short period of time where they got wind of this broken trucking insurer, Markel. It was a Canadian division of an American company, and it was almost bankrupt, and they ended up bailing it out and launched as a single trucking insurance company. And you know within a few years it almost crashed a few times, and but that was the beginning of it.
So let's talk about this float, because in the book you write that he was quoted and says, "Let's buy some float."
Hmm.
Uh, because it became the engine, the growth engine for Fairfax's compounding, but he does it a little bit differently, I think, than Warren Buffett, and doesn't think about it exactly the same way. And so maybe you can help describe that, because it might help especially those that have, always wondered how he thinks about it.
Well, I think it's really what you end up doing with the money, but I mean the float itself is just, it's there to draw upon. You've got to have it tied up and invested a certain way according to regulators and bonds or whatever, but you've also got money to play with in equities and to build that up. And in terms of, I don't know where to even start, comparing to Buffett. Um, I think the biggest thing is they both held insurers. Uh, Warren also got into the third leg of the operating companies with railways and whatever. So it's the same general sort of model, but he always had a more of a concentrated approach to usually U.S. equities. He's taken more, they moved into Japan a little more recently, but it was always U.S. equities and concentrated bets. And for Fairfax, it's been much more diversified and much more global. And
Definitely the investments in India and across the world. So
mhm.
it's always one thing that comes through, I think, pretty repeatedly as I read through the book is Prem's obsession with downside risk. You discuss 87, Japan in 89, the tech bubble, and eventually 2008. Why was he's so it seems psychologically wired towards catastrophe? When many that this time period, despite those drawdowns, has been euphoric, right?
Right.
Why do you think that is?
Um, it's his basic margin of safety is just he's not comfortable when the risk is high, and um, would rather sit on investments that are a little more stable or take a long time to pay off. But their way of looking at risk was on the equity side, and this is the equity is a smaller part of the overall thing. I think it's important to note that those are the things that get headlines, right? I mean, these are the stories that as journalists we wanted to write, is that somebody's shorting something or somebody's got
Yes.
exposure to this stock. Individual stocks and investments don't have huge, single stock influence over their portfolio. They're very diversified. But he did stand out because he is he's great at macro. He's good at bonds. He's good at equities. He's a smart investor, and he's such a good letter writer. There's another thing, and the media would see it. If he's not going to do interviews, at least he's going to write his letter. And so every year, we would parse that, and he would say, hey, caveat emptor, we're watching Japan. We don't like in this 1980s, we don't like the valuations, and as a value investor, steer clear. And they would in the early days, they would just sort of take down equity exposure. In later years, they might have taken some bets that were even more high profile.
Let's dig into that period, which took him on the cover, which is in the it's kind of mid 2000, early 2000s.
Yeah,
And
yeah.
in your book, chapter 3 is literally titled "Growing Pains and Mea Culpa," and that's
Mm.
pretty unusual language, right, for a major corporate history. Where I think and that's what I talked about before, is that the book's kind of open. It says, look, we made some mistakes, acquisition indigestion, strategic errors. Walk us through that, and why do you think that the hedge funds were all over Fairfax, and how do you think he got out of it?
Mm. Um, yeah, there were I think they may a couple of culpas might have referred to some indigestion earlier on, or I wanted to highlight a bunch of the investments that didn't actually pan out. But
For
if we're
sure.
jumping a little bit forward,
No, it's
um,
related. Sure.
yeah, if we're jumping a little forward, the mea culpas were of a different order, I think, of magnitude, and that was so the 1990s were the go-go was the
For
go-go
sure.
period. The stock, everybody got to know Fairfax because the stock did so well, and the main thing that was driving it was acquisitions. So they just kept buying companies. In the early days, it was buying the Canadian assets of U.S. owned companies, and they would pick up the insurance, the Canadian subsidiary sort of units. Later in the 1990s, they started to buy a lot more in the U.S., and especially sort of accelerated towards the end of the decade. And they bought a lot, and they just kept growing. Like, they would double and double and double again in size in a matter of years. And then the problem with, where the later mea culpas kept coming in was eventually, it looks great to your stock. You're adding all this float, all these reserves, all this um, earnings power. Uh, but at some point, you got to make sure that you can fix them. So, and they took a value approach to buying insurance assets that didn't turn out so well. And I think they knew what they were doing, and they built in, protections and structured them in a smart way. But they also, I think, just thought they could fix them a lot faster. And if every year you're taking all your earnings from here and throwing them in to bolster reserves on your money-losing insurance companies, eventually, it adds up. So the indigestion period would have been already visible in the late 90s. I think when it stopped, the music kind of stopped with the tech crash, and a lot of activity died down. So year 2000, and after that, they weren't buying as much, so it was harder to get the market as excited. So the stock started to fall a little bit, and they had a number of assets that they had bought that were trouble, like Crumb, and Odyssey wasn't in great shape at first, and a few others. And that just put them in a bit of a liquidity bind, right? So they had to look at, do we need to sell down some assets? Money's got to come from somewhere. They didn't have money for a rainy day.
And this was around 2006, 7. Is that right?
No, we're looking right at 2000s, early 2000s,
Okay.
and then it all came to a head. So at this point, you just had investors complaining because the stock had retreated. They wasn't
Yes.
being fueled by M&A, and but as the strain sort of stuck, it was, people started worrying that they were not getting their stuff in order fast enough. Then what made it particularly acute was the hedge funds, and that's when the short sellers. So that they went public beginning of 2000, maybe it was December 2002, but early 2003. They basically started trading in New York, and they wanted to raise their profile there. They wanted the added liquidity of being able to tap markets, etc.
Yep.
And what they got was a short attack. So immediately the shorts started loading up on it, and it got messy. It was a lot of clandestine kind of spy caper nastiness, and there were a lot of efforts made to go directly to underwriters like credit raters, to instill doubt, let's say, in the viability of Fairfax itself. So they thought they could kill it, and I think they did their best. So, and having a guy like Jim Chanos as one of those short sellers, who wasn't a central player, I don't think, initially, but he did sign up with a number of other ones, Dan Loeb and Adam Sender. Um, but this guy called Enron, and he called other insurance frauds early in his career. And if he joined in, and he did, saying, we think this is going to be a zero, um, everybody, a lot of people thought that was going to happen. So it was very messy behind the scenes. There's a lot of detail in the book that I certainly wasn't aware of at the time as a
I know.
journalist. There was, it was
You call it
it was
5 days in
a real
July.
test.
There
Hmm?
was a point you label it as 5 days in July, and
Yeah, yeah,
that part
yeah.
reads that part, it reads like a thriller.
It's crazy what happened. Yeah. So
Yeah.
that's
So what happened?
well, that's 2006. So this thing that really sort of kicked into gear in 2003. So I kind of, I'd look at it and people would be always pushing. They'd be calling us, the short sellers,
The
some
shorts saying you got to
research
write
guy.
about this.
Yeah, yeah,
This is
you're way off.
criminal, and yeah,
Yeah,
yeah, yeah.
you're missing the story. This is the
We
biggest
had calls
insurance
we had
fraud.
calls about that stuff too. And
Yeah,
I would tell people, I think you're barking up the wrong tree. In fact, it's interesting. You'll know that Muddy Waters wrote a sell report, a short report
yeah.
last year, 20, I think it was 2025. And he no, maybe it was 2024. I'm sorry.
I think it was
Yeah,
4. Yeah,
24. And we came out right after our guys did a deep dive, and we're like, listen, Carson, it's Carson Block, right? And I
yeah.
know Carson, great guy. He does some phenomenal deep dives. And I said to him, look, I think you got some of the accounting wrong here. I think you're overestimating some things. Yep, we got some problems in some of the investments. It's a bit opaque, but I think you're overplaying things. Stock's been a huge winner since.
Yeah, no, I mean, I think the biggest problem with that one was, I mean, they were identifying, what they felt were the overvaluation of certain assets. And the thing about
Yes,
Fairfax was, for accounting rules, and conservative policies guidelines, they tend to really undervalue, when it comes to marking the
I'll
value
carry
of
on my
their
book. Right.
portfolio. Right. So he was sort of saying this new IPO Digit, which is an Indian online
Yes.
insurer, was being carried way too high, and then it went IPO'd and it was trading at a lot more than he certainly expected. Anyway, that was that crazy time, 2006. It was really amazing how close things got to. It was like gunfight at the OK Corral. The hedge guys for months had been talking, and these are the investigators that Fairfax has, are going to bars and listening to these guys who are telling each other, we
Really?
got them now. We've got these news stories that are going to come out in July, and the stock's going to go, and we're going to finally be able to close our shorts, because it had been a very expensive short. But we're going to kill the company. We're going to dance on their grave. There's going to be a party in the Hamptons in for Labor Day, and Bob Dylan was apparently hired to sing.
You're kidding.
I haven't seen that contract, but that's what people were saying, that the Fairfax investigators were hearing. So they said, "Oh my God!" And they went to Prem and said, Prem already, he didn't really. He just wanted them to go away. He said, "We'll just keep our heads down and."
So he describes this time with no emotion? Come on. I don't believe
Oh,
that.
he does, but he doesn't like to give it any air, I think. So
Okay.
yeah. Anyway, yeah. So there they were, and they countered, because they knew trouble was coming, and they countered with a $6 billion lawsuit, which ultimately didn't really uh, go
Nothing
anywhere
came of that either.
for various reasons, but it was enough to get all of the story that Fairfax was telling out in public, and that was basically the end of it. Yeah.
What do you, but what do you think that sort of what was most learned about that? Um, because some things, it seems to me like there was short selling discussion. Uh, what do you think was the key thing that Prem said, okay, you know what, we need to pivot some of the things we're doing so that this never happens again?
Right. Well, the one thing that really kind of salted that was their version of The Big Short, which came a
That's
couple of years
correct.
later. But yeah, no,
The even bigger
countering
short, as you call it.
yeah, yeah, yeah. The the um the I mean, there were a lot of measures taken, right? They didn't just sit back, cross their fingers, and then fire a lawsuit at them in 2006. During those years, they did a lot of things where they sold off stakes of companies and IPO'd them, of their subsidiaries, and raised money and got added liquidity that way. They did big major bond issues. They did major stock issues, and so there was a long list, sort of things that they had to get done to give them the liquidity to even be able to carry through it. And but in the end, the lawsuit, I think, really really put it to bed. But yeah, so that's 2006. They were already getting ready for the Big Short. They already had their trades going, and
Sort of, I think he anticipated a lot of great financial crisis that was coming. I think that's really what turned the business around, right?
yeah, yeah. And that's another really neat eye opener for me in doing the book, because we all sort of know the Michael Burry
Yes.
and the Big Short movie and the book, but for Fairfax, they're coming at it from a different point, and it's back to risk management, and it's not just sort of seeing this opportunity. There's something crooked there, and you take a big short and you win. For Fairfax, they were worried about the health of their insurers and of reinsurance for their insurers, and who was insuring the reinsurers. And so it was really, and there's great stuff in the book from Brian Bradstreet, who was their fixed income guy, and their discovery of all the toxic garbage that was being marketed as AAA debt,
Right.
and it was full of trouble. And they said, "Oh my God, we got to figure out." And turns out that all the reinsurers that they were relying on to get them to cover them if they were ever in a bind, uh, they were also hugely exposed to it. So they started shorting. It wasn't like Burry taking a direct bet on it. They were trying to make sure that there wasn't this domino going from Fannie and Freddie Mae to reinsurers all the way to the guys in doing reinsurance on their policies. And so it started. This is what was kind of cool. It started with the how do we protect ourselves. It wasn't
Yes.
how do we make a bundle. And of course they realized quickly that if what they were assuming was coming did happen, that they would make a bundle. So it worked out. But it's yeah, I don't know. That was just a crazy back to
But
back
but then
period.
it but then it things kind of so they had the big win in 08, 09, and
Yeah,
then there was a period of kind of can I call it a stagnation or a stalling out, as you like to call it? And
yeah,
then something changed, I think, in 2017, right?
yeah,
As you use as a pivotal moment. And it talks about, you say in your chapter 21, saying goodbye to shorting, right?
hmm
And it's a fascinating line in the book because he says, you finally time to say goodbye to ill-suited short sales. What's that all about?
Well, I mean, I don't know. I can only conjecture, if uh, if it was the success of The Big Short that maybe made them too comfortable with the idea of shorting the market. And there's ways of shorting individual stocks or whatever with options or whatever, but these were short sales on the indices
And,
and
and and I'll tell you, David, it is actually, I've seen it live. A big client of ours at the time, during the in they were in Chicago, and the large hedge fund, they had made an extraordinary amount of money on Enron. Okay, like we're
mm,
talking, it was they bought the Enron logo. When you go into their
yeah,
office
yeah,
in
yeah,
Chicago, they had
yeah,
the E, the original E.
yeah.
Imagine how much money they would have made to buy that, right? I don't know. That hedge fund ended up imploding because the problem with investing and when you get something right is you suffer from being intellectual. You kind of think you're always going to be right and that what worked
hmm
before must work again. And in
yeah,
fact, even the guys, because we know the guys from The Big Short, um, they spoke at one of our real estate conferences, and it's interesting that they said we were never able to recreate the trades. And even David Eisman, right? Steve Eisman, right? I mean, look, he was famous during the time of the .com. He's kind of plunged around in a number of different phases, in a number of different jobs. And no disrespect, he's done very well. but that was the pinnacle of the time. And then
Yeah.
since then, I've spoken to him about various different other trades. It hasn't been so easy to short. In fact, today, there's nobody shorting anymore. You
Mm-hmm.
mentioned Jim Chanos. He's not around shorting.
Mm-hmm.
He's actually
Mm-hmm.
writing research with
Right.
his brother,
Yeah.
Jim.
Yeah.
So,
Anyway, so that's, that's just me sort of conjecture, because they did later say we'll never do it again. But you're right, it had worked out so well, right? Where yes, they were being defensive, but it ended up being a huge offensive move
yes,
for them with the big short. So what we're talking about for listeners is, so they kept
doing the same, trying to do the
going
same
back
thing.
into the market.
Sorry, keep going. Trying to
No,
do
I
the
was just
same
saying
thing.
they went back into the market, so they got their shorts and everything, right? But then everybody's freaked out and they're selling, and all the markets go crashy crash. At that point, they've got a ton of cash, so then they were investing when everyone else was running away. So they just made out so well for a couple of years there. But if you look at the period 2010 to 2016, what happened was you get these aftershocks from the financial crisis, and we
Right.
were in a really low inflation period, and then you're starting to get into deflation. So this is
Yep.
when you have the pigs, the Portugal, Italy, Spain, who were Greece,
Greece. You had
two
that's
eyes,
the
two
pigs.
eyes in there, Ireland, P-I-I-G-S. They're all having debt crises. So at the national level, so being really smart macro guys, they said, you know what, we're really worried about deflation. They started hedging against deflation, and we think that this is going to cause a market collapse. So they started lowering their equity exposure and shorting, and there were a bunch of hedges in there. And again, they were worried about capitalizing their insurers and their investments. They were doing it in a very responsible, almost conservative way. But
Yep.
they also recognized that, hey, it happened before, that this ended up going our way, and we made a bundle. So I think they had some degree of confidence that it would, if they stuck with it, it would pay out. And between that period of 2010 to 16, they lost, billions of dollars through hedging. And so you're not making a lot of money on bonds because it's close to deflationary. You're wiping out your equity gains with losses of shorting. And that's where I think, 2017 is a real turning point. And a lot of it, the sort of spark was Trump getting elected for the first time and coming in with an aggressive tax cut agenda that was going to really, put a lot of juice back into the market and get profits going. And they thought, we don't want to bet against that. We should get rid of our hedges. And we don't want to worry about deflation now, because this is probably going to be ultimately inflationary. And that just led to, I think, a little bit of soul seeking. And Prem owns, every time there's a mistake, he beats himself up in the letter, and he's very frank about
Fantastic.
everything.
Yeah, agree.
And with the shorting one, yeah, he said, never again. Silly me. Not going to approach the market. If we see risk, we'll find other ways to protect ourselves, where we're not at risk of losing a lot of money doing it. So that sort of period, 2017, was a real game changer for
Yes.
them. And that was,
So,
I think that, it sort of turned, and things gradually all sort of fell into place over the next few years. But the way I just describe it in the book is it's just kind of hiding behind all these events. You had a couple of years of massive catastrophe, just forest fires and earthquakes and, everything, hurricanes. And just when that kind of stopped, then you got COVID. And so there's all these huge things happening. Meanwhile, their insurance companies were in way better shape. They've got their equities going now. Inflation's showing signs of starting to pick up, though, and ultimately that would start, allowing them to make money on the fixed income side of things too. So, like, all of those important things, and their assets that they had bought they have Recipe, which is like a holding company for a whole bunch of
Yeah.
national restaurant chains. Um, and then C-SPAN, the shipping, and they've got Eurobank, some massive assets that were just really getting cleaned up and growing. And then all of a sudden, after COVID, that stuff started to become obvious. And it was like, that's what Prem was talking about. I never thought I'd see this. I'm surprised I didn't see that
Yeah.
coming. You know, um,
He
I'm
kind of
sure he knew it was
set
coming.
himself up for success.
Yeah, yeah.
One other part I think of the history, there is some investments that worked out almost by accident, but good decision making. Some that maybe happened and he held on too long. But there's also been a number of these. Let's talk about Blackberry. Let's talk about Greece. Some of the distressed cyclicals that he's purchased that really haven't worked out. I mean, they've been capital pigs, and you step back and you go like, why? And now he's buying Toys R Us and these sorts of things, and maybe it'll be interesting, but is this value, or is it emotional attachment, contrarianism? What is it?
Well, I think, I mean, if you want to criticize him for the excess of anything, it might be patience. He does invest in people and in ideas, and certainly with something like BlackBerry, who knows, the stock's actually been up in the last few
Sure.
days. But that turnaround story didn't quite happen. We
No.
all know that, and they refashioned it, but they never seemed to figure out how to grow it again. There is a business there, but he would be patient. I think for Greece actually is probably the biggest testament to how his patience has paid off. That's one of their biggest success stories, was investing in Eurobank.
Sure, but that
So
took how long did that take?
it took a long time, but it is just it's going great
Over a
guns right
decade.
now.
But yeah,
Yeah,
you're right. And that's the thing.
he's
This is the
thinking in decades, right? It's
Well, that's why everybody says, "Oh, I want to be Warren Buffett." Well, to be Warren Buffett, you can't give me your money. If you want me to invest like Warren Buffett, give me your money, I'll manage it. And then watch how I did this afternoon. Watch how I did in the last hour. Watch how I
uh,
did this second. That doesn't work like that.
yeah.
And that's where I think the biggest problem is. You can be like Warren Buffett if you have capital first. Secondly, it's got to be locked up. And Prem's benefiting from that. He has float. He has now created the success, and that float is significant, and has
Yeah,
patience.
yeah. No, and you got
Um,
to wait for some of those people. Try to, you get your 13F investors, and they're like, who bought what in the last quarter? So I'm going to get on that, and you're expecting, it'll double in a quarter. Not really a good way to invest with any of them, but certainly not with Fairfax. But people might have been bored with the resource stocks that Fairfax had, and look at the timing now for
yeah,
commodities.
exactly.
They've got,
Let's
gold and oil and
and I think that'll help to wrap up here this part of it, and then I want to open it up to you. Is looking at today's environment, and if Prem were here, and based on what you've seen historically and where he's at now, you got elevated valuations, geopolitical fragmentation, AI optimism, deficits everywhere. It looks like higher rates are coming. Who knows?
mhm,
Is he more? Would he be more bullish now? Is he more bearish? What do you
mhm.
think's concerning him most here?
Oh, the safest thing is just to refer, and readers or investors, your listeners should be reading his letter already, because it's a great letter. And every year he sort of pulls all that stuff together, and it's short enough term that you can apply it in your own investing, and but just the way he ties it all together. And the thing is, what might be dangerous, they might have a good plan to take advantage of that. So if he's talking about market risks or whatever, that they may also have a good idea about how to deal with it, and but it takes a long time. He sort of highlights something as soon as they played the whole resurgence of inflation. I call in the book, the big turn, so
Yes.
well by keeping all their money for large parts of a decade in short-term bills and bonds, and because they saw danger in the 10-year and 7-year, whatever, the longer term. And ultimately that nearly took down a lot of insurance companies because, and we had that little mini crash in the smaller US banks, regional banks. And what they did is they just kept their money in a safe place at the short end. They waited for inflation to pick up, and then they just jumped, rolling cash back into not long term, but they're mostly in like 2 to 4 year duration and making 5%, which is huge, big part of their turnaround post 2022. Anyway,
So
so what do they? Would he be bullish? He'll tell you, but they seem to do really well when when the markets do poorly. So
that's
it's
probably, as you mentioned, he has a tendency to be more cautious.
yeah,
He drive with the brakes on. You commented
right.
in part of the book as a description. What do you think is most a misunderstood thing about Prem?
Oh, just why he's quiet. I mean, it's always, if you don't talk a lot, there's a mystery to it, right? And
Yeah,
people can start inventing stuff. He's very open and uh, spends a lot of time with organizations and having a very public personality. He just isn't that interested in talking to the media. So it's they're very genuine. There's so many examples of, they try to keep it simple. They try to say do the right thing. They call themselves fair and friendly. It's where the Fairfax name comes from. For some people, it sounds kind of corny, and but this everybody that I talked to, and I interviewed with all the CEOs who run.
executives,
He's got 30. They've got 30 odd
companies. Yeah.
subsidiary operating companies, insurance and non-insurance, and it's always the same thing. It's just like, this guy is just, he concentrates on trying to do the right thing, and uh, they're strict. He's a man of faith. He doesn't like swearing, so it's like, you check your ego at the door, and it's he's created something pretty impressive there. I think the best judge of trying to measure how culture works is retention. And if you go
Yes.
through, they publish this table, and their managers have been around for like decades, a lot of them, and people don't leave, so they take care of themselves.
Is there one thing that you think we haven't covered that you want to make sure we cover?
No, just yeah, read the book and give me feedback. That's what I'd throw out there. It was a really neat experience for me, being you want to get right as a journalist and somebody who's never really opened up. So I really personally enjoyed it, but I was also really impressed with the people. So it was just a neat experience all around. Yeah.
I think given, you know, 3 decades plus of experience yourself, maybe it's four, in media, and all the challenges that are currently going on. Do you have any comments on that, and where you see that there could be value, or what the thing that's missing today?
Well, for business journalism, I think there are some encouraging signs. There, it's harder as a consumer, as a member of the public, to find the news. I think you have to go to a
Yes,
lot more places than you ever had to. But if you're interested in politics, you've got somebody like uh, Paul. What's Paul's last name? Ha, forgot. The guy who's at McLean's. Sorry, Paul, I forgot your last name. Anyway, he's got great Substack. You've got people like Amber Kanwar, who goes from BNN and does the money manager interviews better than it was ever done on BNN, and just has created her own franchise. So you can do it. The business um, uh, titles, or things like the Logic and Beta Kit, have gone from sort of nichier to much broader roles in covering uh, Canadian business and economics. So those are good, and those are paid for um, publications that are actually making
So
money and hiring people. So it's great.
yeah, I think the difficult thing is, you see, aside from me that does this every day, there's very
Hmm.
few, right? And it's
Yeah,
like getting you're almost every day, the amount of news that comes at you that is must read
yeah,
is overwhelming.
yeah.
And therefore you
No,
run into the problem of what's a signal and what's noise. And today
yeah.
I think there's more noise than I've ever seen in my lifetime.
I think there's lots of opportunity out there, and there's ways of doing it. And thank you to the Globe and Mail; they're still investing, and they've got a lot of good people there. So,
For sure.
there's still good things happening. The Bloomberg's doing an amazing job. Derek DeCluett in
One of your
Canada.
people. Yeah.
Yeah, he's I think they're kind of set the standard. And it's interesting, in the last week, like Wall Street Journal and New York Times are investing in Canada now too. So
Financial Times too. Stay tuned.
yeah, yeah, yeah,
Yeah.
yeah.
And
I love being in London. I love having the old FT, which I always used to think is sort of dry and not as good as when we were at our best. Maybe we did stuff where we pushed the envelope and they were a little more stodgy. But now it's like everything else is kind of not, not a shadow of what it used to be, but not at the same level. But the FT kind of stands out to me. They're like a cut above. And if you like reading the newspaper, like I do, and I know you do, they haven't shrunk it, so you get that nice big,
yeah, the
big.
big, like, notice how much bigger this is than this for all the people watching. You see, so there's
Yeah,
one, and there's the other in terms of the size
yeah.
of the paper itself. Even
I know. It just,
the font is bigger. It's
yeah.
quite interesting all that's happened. So thanks, David. This has been wonderful, fascinating stuff. Uh, two last questions. Always like to ask the guests here. Favorite book that shaped your thinking, perhaps that you look to, or that you just want to share a title. Obviously, yours is a big one, but any others?
I hardly would know where to start, but I thought if I chose one, I would choose The Outsiders, Will Thorndike,
Oh, beauty.
which you've probably read, and
Yeah.
serious business people, especially value guys, will know it. I found it really cool because as I got into, if I took on this mission to try and explain Fairfax, I had to sort of explain that they're not alone. There's a lot of people who are kind of eccentric contrarians. And Thorndike's book was from an allocator perspective, but he ended up clumping together all these different CEOs who were pretty much value guys as well. And it just, the people who are disciplined, who think long term, who create, are concentrate on growing sustained value, aren't interested in quarter to quarter, don't have fancy offices, aren't interested in whole floors of VPs, and would prefer a decentralized approach. So everything about how they operated, it was so cool that he did that book. I hadn't really, I knew of it, but I didn't really. I wish I'd read it earlier. It was amazing to revisit it when I was doing my book, because I was trying to do the same thing. It's like, how are these people different and yet like a lot of other people who are different? This sort of community of
And it's
outside.
interesting, having heard the story and read the book. There's no magic. It's not something necessarily new. It's
Yeah,
just having the temperament, the ability
yeah.
to see things, to stick with your conviction and patience. Um, Lastly, your favorite breakfast restaurant and your favorite breakfast.
Well, this one I struggle with because I'm not a big breakfast eater, but
It's okay.
being in London, I'm in London now for 2 years, and I would say there's one thing people should try. It's on the top time out breakfast place in the world. It's called E Pelici. It's on Bethnal Green. The Cray brothers, famous mobsters, used to eat there, and you can get the full English, and it's just a neat little cafe. I don't do a lot of the full English, so I personally would recommend Bad Manners, which is a burrito truck outside of the Shoreditch Church, and you just have to get to them in the morning, and they've got a really good breakfast burrito. So there's my that's my tip.
So when we're in London next, right?
Yeah. Hmm?
Very good. That's in
Yeah.
London, obviously.
Yeah. Yeah. And I'm here, and I've been in London for 2 years now. So yeah.
Is this indefinite? Are you coming back to Toronto or what?
I have no idea. It's
Okay.
we call it our sort of reverse gap year. Instead of worrying about responsibilities later, and you take your year off, and then you get your mortgage and your kids and your university and all your jobs.
Yeah, you're doing it later.
We've kind of done the work cycle. We got kids launched, and so we ran off to London and sold our house, and who knows where we go next.
David, please stay in touch. God bless. All the best.
Will do. Thanks so much.
Thanks, everyone. Bye-bye.
Bye now.